Is a recession coming in 2025? Yes or no? This week, 57% of investors are bearish, the fear and greed index shows extreme fear, and many tech stocks are crashing. Nvidia is down 27%, Palantir is down 35%, and Tesla is down 47%. So in this video, we start with the summary first, and then I put all the facts into the spotlight. The most important recession indicators give us mixed signals. We're not in a recession just yet. Current sentiment is driven by the fear that Trump's tariffs could re-accelerate inflation and slow down economic growth. The S&P 500 is roughly down 8% from all-time highs, which is a correction. 5680 could serve as a resistance, and we already bounced off that support. But we also could move higher and then go lower. As Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. If you're not invested yet, I suggest you start building a shopping list for ETFs and stocks, save some cash on the sidelines, and consider buying assets as prices go lower and lower. If you are invested already, don't sell, keep your positions, and ignore all the noise. A dollar cost averaging strategy would make a lot of sense. When a recession comes, it could last longer than a year, which will give you enough time to invest properly. Before we get to the recession indicators, hit that like and subscribe button to get more updates like this. Let's get into it. A recession is defined by at least 2 consecutive quarters of negative GDP growth. Right now, this metric has slowed down in the US to 2.3%. It's not negative just yet. In Germany, we have a first quarter of negative GDP growth of minus 0.2%. And in Italy, it's exactly 0%. So economies around the globe are in a different position. For the US, the Q1 forecast is not looking great, to be honest. GDP growth is expected to be minus 2.8%. This number will be announced on April 30. Next up, we have the inverted yield curve. The 10-year Treasury yield passed below the 3-month note on February 25th, and that's why many people freak out. It's known as the inverted yield curve, and usually it predicts a recession within a 12 to 18 month time frame. This indicator is telling us a recession is coming, but this isn't a perfect predictor all the time. The previous inversion happened in October 2022, and we haven't seen a recession 2.5 years later. Back then, the US showed strong job growth and good consumer spending. That leads us to the unemployment rate. When unemployment rises, consumers typically spend less, which further slows down economic growth and impacts earnings and stock prices. The unemployment rate in the US is currently hovering around the 4% mark for a couple of months. But if it spikes rapidly in the future, then a recession is likely. Very connected is consumer spending. This metric accounts for more than 2/3 of the US economic activity, and it dropped 0.2% in January 2025. It's the first drop in roughly 2 years. Trump's administration is launching a cascade of tariffs, which could lead to higher prices as businesses pass on higher costs to consumers. Will it turn out that way? We will find out. We have the first warning signs for consumer spending, but it's too early to panic. Okay, the final indicator is housing starts. This reflects the number of privately owned new houses on which construction has been started. Declines in housing starts slows down the economy and can push it into a recession. On a 12-month average basis, housing starts have been rolling over from their peak. In January 2025, we saw a decline of minus 10%. Plus, inflation-adjusted US home prices have now surpassed the peak of the mid-2000s housing bubble that led to the crash in 2008. In summary, it's not clear if we get a recession or just a slowdown economy. A recession might come early 2026, but as stock prices get lower and lower, it's time to consider buying slowly in. If you enjoyed this video, then click like and subscribe. Thanks for watching and see you in the next video.